All right, the Nifty was down around 0.5% in what was a predominantly very range-bound kind of a week. So that's how it played out. In terms of the top Nifty gainers, not too many big gainers to tell you about, and but nonetheless, the weekly gainers included the likes of an HDFC Life, an Eternal, a Kotak Mahindra Bank, a Power Grid courtesy the move, in fact, entirely courtesy the move of today. In terms of the others, Axis Bank also was up 2% odd. So no big gainers per se, but the losers were there. 5% low on Tata Motors PV. HCL Tech was down 4+%. Infosys down 4+%. Interglobe, ITC, HUL traded down by over 3% as well. So that was the tilt. In terms of sectors, and again, when you're looking at sectors this week, you saw realty down around 1.9, metals down 1.7. The Nifty IT was down 2.7. FMCG was down 2.3. PSU banks were the other laggard. They were down around 1.8 odd %. So you saw some gains coming in, frankly, from within the metals pack as well as the realty pack. Those were the two sectors which actually stood out. And even within realty, in fact, it was Brigade. That stock was up 7%. And metals were aided by the likes of a Welspun Corp. Again, those individual movers have actually played well this week. 14% higher on Welspun Corp. Vedanta was up 4%. Hindustan Zinc was up 4% as well. So that was really the tilt. In terms of the Nifty 500 index, and again, I'll quickly point out to some top gainers and losers from within that pack. And week to date, in terms of, first off, the biggest losers, Himadri Spec was 16% lower, again on the back of numbers, largely because of the move on Monday. Schneider was down 11%, again numbers. NMDC Steel, again numbers down 11 this week. Bellrise, Aster DM, as well as CESC, which is some of the other big movers in trade this week from within the Nifty 500 index. Welspun Corp led the gains, 22% higher. Jyoti CNC has had a stellar run, 20% gains over there as well. Balrampur Chini, Welspun Living, Aegis Logistics, which is some of the other movers. But in terms of the coming week and what we need to keep our eyes out on, Sunidhi here with all of the cues you want to watch out for the coming week of trade.
Here are the key events to watch for the upcoming week. Starting with India, we have the industrial production data coming up on August 28. Moving on to the global markets, in the United States, we have the key data coming up for consumer confidence, GDP, PCE inflation, and jobless claims. Eurozone consumer confidence, China's industrial profits, and Japan's unemployment and Tokyo CPI will also be tracked. Moving on to global earnings, Nvidia is set to report earnings on August 26, while BYD will be reporting earnings on August 28. Talking about corporate actions and board meetings, several companies including Tega Industries, Gabriel India, Piramal Finance and UCO Bank are all set to consider fundraisers. Meanwhile, TD Power Systems and Waterway Leisure Tourism have record dates coming up for respective stock splits. Talking about IPOs, the week will see multiple IPOs opening, including Tempson Instruments, Skyways Air Services, High-Tech Engineers, Symbiotic Pharma Lab and Anu Projects. Now, finally, moving on to other events, we will see that ECB will publish its latest meeting accounts on August 27, while Fed Chair Kevin Warsh is expected to speak on August 28.
Okay, thank you so much for that, Sunidhi. Let me bring on board Dhananjay Sinha, CEO and Co-Head of Equities at Systematix Group, joining us this afternoon. Dhananjay, it's been a volatile week of sorts because there's just been so much happening on the global front. What changes from a macro perspective? Good afternoon. Let's start with that first off. How do you look at the macros and from India perspective, global perspective and rate perspective?
So I think from a global standpoint, I think lots of things are happening. Of course, if you look at the latest discussion, I think it's around the fact that global risk-free rates are rising. So if you look at US 10 years has been hovering around 4.6, 4.7. And the latest data shows that their public debt, the government debt has risen to almost like $40 trillion, roughly $2 trillion addition in the last 10 months or so. I think 1 trillion has been added over the last 5 months or so. So there is a considerable anxiety around that. In the US, there is a considerable amount of momentum as far as the debt fundraising is concerned from the AI pack and the whole value chain that is there. So I think that is creating a kind of a crowding out effect, and that is keeping the interest rates in the US higher. And we are seeing that also in Japan. The 10-year has gone up to almost like as high as it was in 1996. So I think that world over there is an increase in the risk-free rate, and people are worried about the fact that with crude going back to 90, 100 range, the inflationary risks are there. As a result of that, there is a sort of growing sense that there will be a rate hike cycle going forward. I think that is very critical development from a valuation standpoint. And I think in the AI world, there has been a significant amount of valuation bubble that's been there, and there is a certain amount of correction that is happening. So we'll need to watch how would that translate into the broader markets, especially on the credit side in the US AI world, and how does it sort of pan out. So I think that is one. I think while the Middle East war has kind of subsided, the kinetics have actually faded. But I think it is transitioning into more economic aggression from the US standpoint. I think that that conflict still is alive. So that is what the global context is. I think from an India standpoint, of course, we had the result season that has gone past just now. I think people have taken a certain amount of respite from the positive surprises that had happened over there. And especially in the context of the fact that the AI stocks had actually fallen, I think there was a certain amount of sentiment in the IT stock space where the sector has seen a significant de-rating over the last 2-3 years. And there is a certain bottom fishing that's been happening recently. So that is another thing that people are looking at. We have a view on that. So basically, people are worried about domestic as well, with inflation rising and the yields also rising. And, people are sort of drawing some assurances from the fact that FCNRB mobilization has been higher than expected. And the RBI said that they would stop at about $80 billion. So I think those are the considerations that the market is having. But net, what we are saying is that if you look at the trailing earnings for Nifty, for instance, is just about 4%, despite the positive surprise that has happened in the first quarter this year. And if you look at the broader segment, if you look at BSE 500, we have data for almost like 450 companies. The earnings growth has been of the tune of 7-8%. We have seen increase in material costs, raw material costs rising by 40%. Companies have passed on some part of it. Margin pressure has been there, and we still have certain tailwind coming from the GST reduction that had happened last year. So we will need to see whether the earnings momentum can pick up from here on. We know that global surveys are still pegging India at the lower rung of the investor preference, while we see that retail, flows have actually moderated more recently. So I think it's a mix of things. Whenever there is a sort of a positive momentum, we see good activities in the primary market. So it's kind of mixed things that are there. But by and large, the market is not really moving in this. If you add up all of that, it's not really moving. So the returns are not coming by for the retail investors.
Dhananjay, I'll just take a pause here. The earnings season ended last week, right?
Yes.
Tell us, what were the big surprises for you? Just give us the top 2 or 3 in terms of what really stood out for you in the earnings season.
So I think in the banking space, I think it's kind of a mixed bag. There has been a fairly robust lending growth of almost like 18% at the systemic level. What we find is that the smaller banks have actually outperformed in terms of the overall profit growth. And as a result of that, if you look at year on year, smaller banks have actually demonstrated much stronger performance and versus the larger banks. I think some of the PSU banks have also done well, but I think the larger banks are struggling in terms of with respect to the cost of deposit. There is a significant competition on the deposit side, and CASA is actually decreasing across most banks. So I think that is something that has stood out. I would say within the consumer space also, I would say the premium segments have actually done well, versus the value players. It does look like some of the consumer companies have been able to pass on the price hike better than others, and there is a good performance that is happening in select segments. I think auto space continues to do well. I would say they do have the performance being supported by the GST cut that had happened last year. So the volume growth is still pretty good, but right now, what we are considering, we were overweight on banks, on autos, but we have sort of moved, we have tempered our optimism because we see that there is a increase in raw material cost, which might have an impact going forward. And I would say as the base effect of the of GST starts to kick in, I think the volume growth will also start to come off. So volume is kind of peaking out, I would say. So we have sort of tempered our expectation or in the auto space. Beyond that, I think some of the I would say power sector, energy sector has done relatively better. I would say metal space also, because of better realization, especially the non-ferrous segment, has actually outperformed. So I think broadly, I would say certain segments have done well, whereas if you look at the overall aggregate picture, it does look like the cost pressure is fairly intense. And I think the sensitivity of corporate performance to rise in raw material cost, and especially the crude prices, is actually fairly elevated at this juncture.
Okay, let's talk a little bit about banks, Dhananjay, because they've underperformed, right? And there's been a vast underperformance, and there's a consensus buy call. In fact, I was looking at ICICI Bank's valuations earlier this week. It trades at 2.3 times book 1 year forward, and this is the consol book. HDFC Bank, on the other hand, trades at 1.7 times book 1 year forward. So, and this is again consol. So if I look at the standalone numbers, it looks even better. And while ICICI is growing at a faster clip, HDFC is growing at a lower clip, but a lot of the pain seems to be built in. What then is keeping these stocks from really moving?
So I would say if you look at the headline number, as I mentioned earlier, it's fairly robust. I would say some of these banks have been able to show better growth if you compare over the last 4 quarters and all. So the problem in the banking sector is that it is not really translating into core earnings growth, because the pace at which the interest income is growing is much slower than the lending growth. So it means that the average yield has actually fallen, and the lending mix has actually moved more towards corporates and prime lenders, prime borrowers. As a result of that, the average yields have actually been on the softening side, whereas at the peak level of credit deposit ratio that banks are in some of the banks that you mentioned are are above, let's say, 90%. They are sort of struggling on the bank deposit side. The CASA deposits have actually been slowing, and the ratio, people are struggling on the fixed deposit side. So the term deposit rates is also sort of having an impact on the cost of fund. So overall, I would say the NIM expansion is not very decisive. I think the positive side, there has been a certain benign scenario with respect to credit cost. But what we think is that the NPA ratios have started to move up. So going forward, you have a situation of high level of CD ratio. Banks are not able to increase their ROEs and the NIMs. I think that's something that the market is worried about. And in the context where the RBI is expected to increase rates and interest rates are rising, it's quite likely that the cost pressure might actually start to impact going forward, especially for, let's say, HDFC Bank, which has been campaigning on very aggressively on deposits. with a rising rate scenario, the banking sector might actually see increase in cost of fund. So I think those are the worries that the market is looking at. In the results, what we also find is that banks are trying to economize on the cost, especially the spending on salaries and compensation.
Right.
PSU banks have actually been curtailing. It's been decreasing there, and private banks are also sort of rationalizing the pace at which they're growing. The compensation and all is slowing. So in a way, the banks at the peak level of lending growth, they still need to optimize on their cost to protect their profitability. That's a fairly unique scenario, and that is what the market is looking at.
Okay, all right. We'll step in a very short break, come back, continue that conversation with Dhananjay. Very interesting view on IT as well that Dhananjay and Systematix Group has. We'll talk about that on the other side. Stay with us. Welcome back, and Dhananjay is still with us. Dhananjay, I have very little time. Very quickly, the view on IT.
So I think, see, the thing is, the whole debate is about whether the AI expansion that is there, whether it is undoing the effort-based business model, and that's where the Indian IT companies are focused on. I think what we are saying is that there is a certain amount of substitution that has been happening with US companies investing in AI, and that's kind of impacting the allocation for Indian IT companies. We are saying that it will, so the whole thing is, so we'll need to really wait for the full AI cycle and investments in infrastructure to play out before larger opportunities arise for the Indian IT companies. At this juncture, with the low valuation that the IT companies are in, people are kind of seeing a rotation out here, but we think that it will still be back-ended. Select IT companies are investing a lot on AI capabilities and all. They might actually do relatively better. But broadly, I would say it will still be some time before the re-rating story pans out.
Okay. Dhananjay, that's unfortunately all the time I have today, but very good speaking to you. Thank you so much for coming in and speaking to us. Completely timed out, but up next, an exclusive roundup of the week's key developments from Maharashtra in our Maharashtra 360.